All right, in this lesson, we are going to be talking about deferred revenue. So in the last couple of lessons, we talked about deferred expenses. Now we're going to look at the revenue side and looking at what that revenue side looks like from a deferred standpoint. So let's get started here by talking about what we already know. So remember that an adjustment, what its purpose is to adjust our books to what it should be based on activities during the period. So we've got an example here that you've seen before. And in this example, we can look at our books, and our books, for instance, might say that our revenues was $2,000. But we know based on all of our interactions and transactions and what we did over the past period, it should be more like 3,000. So our books are out of whack by about $1,000. So this $1,000 would be the adjustment that we need to do from a deferred revenue standpoint. Okay, so that's what we have to do from an adjusting journal entry. Now, in a deferred revenue situation, we are receiving the cash up front from our customers. Cash is being received now, but the revenue will be incurred later. So in that chart that I showed you, we performed the services that we were going to, or we provided the product, and we should have $3,000 in revenue, but we only booked $2,000. Why is there a difference? Well, we haven't booked the revenue for that $1,000 that we've earned from that deposit that we received from the customer a while back. Now, a deferred revenue adjustment is made to move the amount of the deferred revenues to the revenues when the revenue is earned. So what it would look like is the original entry is when the customer gives you a deposit or a retainer. In that case, the journal entry would look something like this. We would debit cash because we would receive cash, and we would credit deferred revenue. We wouldn't credit sales revenue because we haven't earned it yet because we haven't provided the service. Now, once we've done that, then we can perform the service or perform whatever performance obligations we're supposed to deliver a good. And when we do that, we're going to get a journal entry that looks something like this. We're going to reverse out the deferred revenue, and then we're going to book the revenue. So the way that I like to think about it is I'm taking it out of deferred revenue and putting it into the revenue account. I'm just simply transferring funds from one account to another. So if you notice here, when we first did the original entry, we credited deferred revenue. To take it out of deferred revenue, we got to do the opposite. What's the opposite of a credit? The opposite of a credit is a debit. So notice here, we're going to debit that account when we do the adjusting deferred entry or the adjusting journal entry, and then we're going to credit what should be credit, which would be the revenue. Okay, so that's what we did here. Now, again, remember that the amounts here doesn't have to necessarily match. So for instance, if a customer pays us $1,000 up front for 10 units of X, Y, and Z widget, and we only deliver 5 of them, then we're only going to transfer $500 to the revenue account rather than $1,000. And then a couple weeks later, we deliver 3 more, then we'll transfer $300 to the revenue account, leaving us $200 in deferred revenue. When we finally deliver that second one, then we can transfer the last $200. So we don't always have to transfer the full amount to the revenue account until we actually perform all of our performance obligations based on our contract with our customers. So understanding that, I don't want to get too confusing here, but we want to make sure that that doesn't always plan out evenly when we do the adjusting journal entry. So that does mean that we might make one original entry and then we have to do 3 additional adjusting entries later on. And if that's what it has to be, that's what it has to be. All right, so here is an example that we're going to walk through here. A couple last month put $1,000 down for a deposit for use of the Walnut Creek Inc.'s facility. The wedding has now passed, and Walnut Creek has earned their $1,000 deposit. So what's happened now? Well, Walnut Creek might have revenues of $7,500 right now. Based on this event already passing, their revenue should be $8,500. So now we have a difference. What is that difference? That difference is $1,000. So that $1,000 represents the amount that has now been earned that was previously not booked as revenue. So 8,500 minus 7,500 gives us $1,000. So we need to make an adjusting journal entry for $1,000. Why? Because we've now earned that $1,000, which was previously in deferred revenues. So let's look at our journal entry here. So the original entry probably looks something like this. We would have debited cash because we received cash of $1,000, and we would credit deferred revenue for $1,000. So that would have been the original entry. When the couple gave us $1,000, this is what we would have booked. We would have accepted the cash. Increases in cash as an asset is a debit, so we'll debit cash. And then the deferred revenue is a liability, because if it doesn't happen or something goes wrong, we have to pay it back to them. So we'll credit the deferred revenue, which is a liability account. Now we no longer owe that amount to our customer, so we have to reverse out the deferred revenue. And we also need to book the revenue because we've now earned it because they've used the facility. To do that, we first get rid of our liability. To get rid of our liability, we do opposite of what we did when we incurred the liability. In this case, we credited deferred revenue, so we are going to debit deferred revenue. And then we are going to credit service revenue for $1,000. So that's booking $1,000 for the revenue that we have earned. So if we were going to put this on T accounts here, I've already done the original entry, so we'll skip down to the adjusting entry. In our deferred revenue, it was a debit to deferred revenue, which is $1,000. So we are going to the beginning balance here is incorrect. So give me a second. It was a liability, not. So we're going to debit deferred revenue. So that would give us a 0. And then we're going to credit sales revenue of $1,000. That would give us $8,500. So that's what it should look like. Apologize for the error. It happens, debits and credits. So that's what it would look like here. We would have started with the deferred revenue of a credit of $1,000. We'll debit that $1,000, making deferred revenue 0. And then our service revenues go up by $1,000, in this case to $8,500. So that's what it would look like from a T account perspective. So that is a look at a deferred revenue transaction. Remember that a deferred revenue occurs when we receive cash before we perform our services or produce our product for our customers. Therefore, we have to defer the revenue that we're booking until we actually perform the performance obligation that we're contracted to do. If we haven't done it yet, we can't book it into revenue. So we make an adjusting entry after we've completed that task to book it from the deferred revenue to the revenue account. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.